Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. I hope everybody is doing well and in good health. If you remember, in the last lecture we have learned operating leverage, and you have learned the purpose and the idea of operating leverage. But today we are talking about financial leverage, and we have already explained the concept and the idea of leverage in the beginning or in the first lecture of operating leverage. So dear students, what is financial leverage? Financial leverage is the use of fixed financing costs by the firm, right? The British expression is gearing. So dear students, financial leverage is the use of fixed financing cost. If you remember, in operating leverage, what was the operating leverage? The use of fixed operating cost. But here now we are talking about the use of fixed financing cost. Okay, so dear students, what's the difference between fixed financing cost and fixed operating cost? If you remember, we have explained that the fixed operating costs, or like fixed rent or fixed salaries or many more fixed costs we have, which are required to run your business or which are needed in business operations. But what is fixed financing cost? So dear students, if you remember, you have learned in a very much beginning of the business finance course or the financial management that there are three broader area of finance managers, right? One is financing and investing, and the third one is asset management, right? So in the financing decision, we have financing. Financing is raising fund. When you acquire funds or raise funds from banks, you are issuing financial securities or shares or bonds or whatever. So that is what we mean by financing simply. But what is financing cost? Okay, dear students, when you raise fund, like you are getting a loan, then raising fund is not for free. You have to pay some cost for that, and usually we are paying interest for that. Okay, so the fixed interest we are giving at the end of a year or a month or whatever is the credit period term, right? Then that fixed interest is called fixed financing cost. I hope you have learned. Once again, when you get a loan or when you acquire a loan from bank or from any credit union or institution, then you are paying some fixed cost, some cost for this financing, and that is called fixed interest, right? So the fixed interest we are paying, right, that is called fixed financing costs. But keep in mind, dear students, whenever we raise funds by issuing bonds or by issuing short-term securities like capital notes or T-bill or T-notes or whatever kind of bonds, then the fund we are raising is actually treated as a loan for a business, as a liability for a business. And whenever a company or corporation get loan, then the company is paying back interest on that. Okay, why? Because the financing is not for free. But keep in mind, whenever the fund is risen from the shareholder, then the fixed interest is not given to them. So when we talk about financial leverage, it's mean raising loan or raising debt. So if you finance by issuing shares, right, then there we are not paying interest, we are paying dividend, right? So by financial leverage, we simply mean whenever you are acquiring or getting loan. Why? Because for loan we are paying some fixed interest. So the use of fixed financing cost by the firm, right, this is called financial leverage simply. So if a company is not having any debt, right, then we say the company is not using any financial leverage, or there is no any financial leverage. So financial leverage is whenever a company is raising funds, and by debt, it means raising loan. Okay, so in the British term it is called gearing. Okay, gearing means raising fund. If you remember, you have studied in financial statement and in financial business finance about the financial statement ratios. So in those ratios we had financial leverage ratio. So all the financial leverage ratios, they were related into the debt. So that is why when we talk about financial leverage, we mean by debt. Okay, in the British term it is called gearing. Okay, dear students, why we call it a leverage or financial leverage? Why? Because when you raise a debt, so it is providing some leverage. And if you remember, I have explained this concept in the beginning of the business finance course in the first lecture, that whenever we are raising debt, so the raising debt is increasing the return to shareholder, and that is actually the leverage. When there is no debt in a company, it means the return to the shareholder will not be higher. But when you try to increase the amount of loan in a business, it means the return to the shareholder will become higher. So the higher is the loan, the higher is the return to the shareholder. So that is what we mean by leverage. Why? Because by having debt, there is some benefit, right, to the shareholders, and that benefit is what we mean by a leverage. In operating leverage, if you remember, when we were using the fixed operating cost, then the proportional change in the profitability were higher, right? But in a financial leverage, when we try to include debt in our financing, then that increase return to the shareholder. So dear students, now the financial leverage is acquired by choice. This is another point. When you raise a loan, so that is a choice. You're not obliged, and that is not necessary. Whatever source you're selecting for financing, is you have a choice there. Okay, so used as a means of increasing the return to common shareholder, and that is what I'm explaining here in the financial leverage. The financial leverage that is used to what? For increasing the return to common shareholder, right? Okay, that is the difference between the operating leverage and the financial leverage. When you use operating leverage, it means when you try to include the fixed operating cost in your business, then that will increase the sensitivity in the profitability. It means when you increase a sale a little bit, so the profitability will jump higher. But in a financial leverage, when you try to include the debt in your business, then your return or the return to the common shareholder will increase, right? That is because of debt. Okay, dear students, if there is no debt, yes, definitely there will be a shareholder, but relatively or comparatively, if you include a debt in a business, so the return will become higher in that situation. Okay, now in this lecture we are talking about EBIT, EPS. EBIT means earning before interest and tax, and EPS means earning per share, break-even analysis. Okay, so what is the EBIT, EPS break-even analysis? That is the analysis of the effect of financing alternatives on earning per share. Okay, the break-even point is the EBIT level where EPS is the same for two or more alternatives. Okay, so this definition of the EBIT, EPS break-even analysis, that will be clear if I'm just working on this exercise. Inshallah, I will make it clear for you. Okay, so I'm just coming into this point back. So what is required here? Calculate earning per share for a given level of EBIT at a given financing structure. So now we try to calculate earning per share. Okay, and what is the formula of earning per share here? And that is given here. So dear students, just look and pay me attention. We have a company by the name of Basket Wonder. The Basket Wonder has 10 million in long-term financing. How much the Basket Wonder is having? $10 million. Okay, financing 100% common stock equity. Right now the company is having 10 million. So the 10 million, this is the current capital of the company Basket Wonder. Okay, now what is required here? This company, the Basket Wonder, is interested to raise 5 million new financing. How much? 5 million. So right now current common stock shares we have 200,000. This is number of shares we have. So it's mean that 10 million divided by 200,000, it's mean $50. $50, that is the value per share we have. So the company is needing additional 5 million, means along with this $10 million, the company need another $5 million for financing. Okay, so there are three options available. One is all common stock sold at $50 per share is equal to 100,000 shares. Okay, one option is if you want to raise $5 million, so one option is to issue the shares. How many shares? 100,000 shares. Why? Because if we are issuing one share for $50, so 50 into multiply into 100,000 is equal to how much? 5 million, and that is required. Next, the second option given is all debt with a coupon rate of 12%. Okay, the second option is the company can raise this fund by issuing a debt security, right? So one is to get a fund by issuing the shares. The second option is to get a loan, to get a debt. Okay, so if the company select the second option and get $5 million, then the company should pay how much interest? 12% interest for debt. So this is the second option. The third option is all preferred stock, right, with a dividend rate of 11%. So dear students, the company can issue shares, right, to get $5 million. The company can also get a debt, right, by issuing any debt security and getting how much? $5 million. And the company can also issue the preferred stock. And you know the difference between the common stock and the preferred stock, right? Why? Because the preferred stock is given the preference over the common stock in paying the dividend. And also the common stocks, they are called the final or the real owners, and the preferred stock, they are given a fixed dividend, but in the common stock, they are the common stock shareholder not receiving fixed dividend. Okay, so dear students, for raising $5 million, there are three options. Now, how much is expected EBIT? $2.7 million. What does this mean? This means if the company raise $5 million, right, and put this $5 million in a business and generate a sale by the help of this $5 million, then there is expected EBIT of how much? $2.7 million, earning before interest and taxes. Mean by raising $5 million, it is expected that the company will generate $2.7 million or $2,700,000. What expected earning before interest and taxes? And how much is the tax? 40%. So now, dear students, we are evaluating these three options, right, and check which option is better for us, and that is what we try to know. Once again, I'm just repeating, we need 5 million for this company Basket Wonder, and there are three options available, right? Now these three are equally attractive for us, but we don't know which one is better. Now we start some analysis. We are doing analysis, and by the help of the analysis we will make sure which alternative is better for us. Okay, so dear students, come here. In this table we are just doing some analysis, and you will finally understand which alternative will give us higher earning per share. So if you are selecting any alternative here, and among these three alternatives, so each and every alternative will give you $2.7 million EBIT. So we are just mentioning here 2,700,000. Okay, that will be the EBIT in the common stock, or and also in the debt, and also in the preferred dividend. Okay, so it's mean whatever alternative you are selecting, EBAT, the earning before interest and tax will be same. Okay. So the second, dear students, what we're doing here right now, we need to compute earning per share. It means if you raise this $5 million by the help of the common stock, means issuing the common stock, how much will be the earning per share to the shareholder? How much will be the earning per share? This is what we try to find, earning per share. Okay. And if you raise a debt, it means if you raise $5 million by issuing a debt security, again you will have $2,700,000. How much will be the earning per share here, and how much will be the earning per share in the third alternative? And that is what we are trying to analyze. Okay. So dear students, here in the second point we have interest. Okay, if you raise $5 million common shareholder or fund by the issuing common shares, then will we pay interest? No. Why? Because we are not paying interest when we raise fund by the issuing shares. So that is why the interest is 0 here. Okay. Okay, next we need to compute EBT, earning before tax, right? So from this $2,700,000, when you minus interest, how much will be the EBT while we are not having any interest? So the EBT will be again $2,700,000. Okay, how much is the tax we have to deduct from this? 40%. Okay, so equal sign and just click on this value and multiply with 0.4. So $1,080,000 taxes we have to subtract from this. Okay, when you minus the tax from $2,700,000 minus the taxes, we will have 1,620,000 EAT. EAT means earning after taxes. From this earning, right, when you minus the taxes, so this is called EAT, earning after taxes. Now next, do we have to pay dividend to the common stock? No. Why? Because the dividend, the preferred dividend is given to the preferred stock, not to the common stock. So that is why again it is 0. So how much is earning available to common stock? So equal sign from EAT minus the preferred dividend. So we'll have 1,620,000 again here. This is what is called earning available. EACS means earning available to common stock. So this is the earning. It means if you raise $5 million by the help of the common stock, so the earning to the shareholder will be available after to deduct taxes and the interest, right? How much? $1,620,000. So dear students, how many number of shares we have here in order to compute earning per share? So right now the company has $10 million, and how many current common shares the company has? 200,000 shares. So if the company is raising $5 million by issuing shareholder, so additional 100,000 shares is coming. It means total we are having here 300,000 shares. Okay. Okay. Finally, we need to compute EPS, or earning per share. So very much easy. So earning available to common stock should be divided by the number of shares. And finally we have 5.40. What does this mean, dear student? It means if you raise $5 million by issuing the common stock or common shares, so the earning per share to the shareholder will be 5.40. In this situation, each and every shareholder will get how much per share? $5.40. Okay. So this is what we have computed for common stock, and the same we have to compute for debt. Okay, if you are selecting the second alternative and raising $5 million, again you will have $2,700,000. But keep in mind, for debt you have to pay interest. Why? Because it is not like a common stock. In the common stock we are not paying interest, but for the debt we are paying interest. Okay, how much is the interest? Look, for the debt interest is 12%. It means How much loan we are getting? $5 million. It means on this $5 million we have to pay 12% interest. So equal sign, right? In 5 million multiply by how much? By 12, 0.12. So the interest you have to pay to the creditors for the debt you have acquired, how much? $600,000. Now how much is the EBT, earning before taxes? So from the this EBT minus interest, we'll have how much? 2,100,000. Look, the EBT, earning before interest, is different here. Here is 2,700,000. Here we are paying interest. Okay. Next we have, dear students, taxes. You have to subtract taxes. So 2,100,000 multiply by 0.4. Okay, that is 840,000 is the taxes you have to pay. And next we have EAT, earning after taxes. So dear students, from this EBT you have to subtract the taxes, and finally you'll have $1,260,000. This is what is called EAT, earning available, right? This is earning after taxes. We have subtracted taxes here. Okay, now we have to minus preferred dividend again, and the debt we are not giving any dividend, so it is 0. Okay, earning available to common stockholders, that is how much? Again, $1,260,000. that is remaining to whom? To the shareholders. So how much is earning? How many numbers of how many numbers of shares we have here in the debt? Okay, look, if you raise $5 million by issuing debt security, so the number of shares, right, or not increasing. You know why? Because when you issue shares, so the number of share increases, but when you are not issuing share, you are raising funds by debt, so definitely the number of shareholder is not increasing when you are issuing bonds, right, or when you are getting loan. So that is why the number of share remains the same. Okay, 200,000. Finally, how much is earning per share? From earning available to common stock, you have to minus, you have to divide by the number of share. So we have 6.3, right? So dear students, if you select the first alternative, so the earning to the shareholder will be 5.40 per share. But if you select the second alternative, then the earning per share will be 6.30. Okay, dear student, now we are coming into the preferred stock. Again, if you want to select the third alternative, then again you will generate $2,700,000. Why? Because the 5 million is same in all alternatives. But now on the preferred stock, or the fund we have raised 5 million from the preferred shareholders, right, or through the preferred stocks, we are not paying any interest here, so that is why interest is 0. Okay, next we have EBT, earning before taxes. So again that is coming same. Why? Because there is no any interest. Okay, now you have to subtract the taxes. So the taxes of $2,700,000 multiplied by 0.4, that is equal to 1,080,000. Okay, how much is EAT from 2,700,000 minus taxes? We have $1,620,000. Up to this point is same with the common stock. Why? Because here we are not paying interest. Again, here we are not paying interest. But dear students, now we need to pay the dividend. And to whom we have to pay the dividend? To the preferred stockholders. Okay, and here it is given that if you raise a fund from the preferred stockholder, then you have to pay 11% dividend. So equal sign, how much is the fund? We are just getting 5 million. So on 5 million you have to pay 0.11, 11%, and that is equal to $550,000. and this is you have to pay to the preferred shareholder for the funds you have raised from. Okay, next we have earning available to common stockholders. So from this amount you have to subtract the dividend to pay to the dividend. So how many shares we are having in this situation? Again, the number of shares not increasing. Why? Because if you raise fund by issuing preferred stock, so why does the number of the common share increases? Right, so the number of common share is not increasing if you are issuing, right, preferred shares. I think it's quite logical. So that is why 200,000, again we have the number of shares. So now how much is earning per share? So equal sign from the total earning available to common shareholder divided by the number of shares we have, and that is equal to 5.35. So dear students, you have learned here what if you are using the first alternative, so the earning per share is 5.40 here, and if you are using the second alternative, the earning per share is 6.30, and here is 5.35. Now if you are attentive, which alternative is providing you with a higher earning per share? Very much clear, the debt, right? And the second number, the common stock, is providing you with a higher earning per share. And the third, the preferred stock. Okay, if you want to raise this 5 million, you think which alternative is better for you here? So obviously the debt is good here. Why? Because the debt is providing more earning per share, and that is what I'm just talking about, the leverage here, that if you try to use, right, debt as a financing, it means you can finance by the issuing common stock, and you can finance by the issuing preferred stock, and also by debt. But if you select among these alternatives the debt alternative, then the earning per share will be higher here, and that is how much? 6.30. So dear students, what is the logic behind why the earning per share is coming higher here? Very much clear. Why? Because if you remember, the interest we are paying here before taxes, look, we are paying interest $600,000, and what is the remaining amount? And that is $2,100,000. So from this $2,100,000 we are paying the taxes. And how much is the taxes? And that is 840 and 000, right? So it's mean the $600,000 we have not paid any tax. Okay, so for example, suppose if the company is paying the taxes, this taxes after the interest, it means you are not deducting the interest, so you have to pay the interest, the taxes on a $2,700,000. So the company have to pay the higher amount of taxes, but now the interest is deducted here, $600,000, and after that on the remaining amount of $2,100,000 the tax 40% is charged. So you can say the $600,000 interest what you are paying, you are not charged for taxes, and here is the tax shield. It means the benefit you are receiving here because of this debt. The debt is providing you the higher earning per share. The reason behind, because for the debt we are paying interest, and the interest is not tax. Whenever the interest is not tax, that's why some margin or some tax shield or some benefit. What is the benefit here? The interest, right, which is saved, you have not paid for this $600,000, that is accumulated or added here, and your earning per share is coming higher here. So dear students, this is very much clear point. Okay, so in other words, the cost of debt is two reasons you can say. One is the cost of debt. How much is the cost of debt? $600,000 you are paying, and this is fixed amount, and this is usually less. So one reason the debt is providing the higher earning per share is that the cost of the debt, which is $600,000, is a fixed amount, right, and that is less. And the second, this debt is a tax deductible. It means you are not paying a taxes on this $600,000. So that is why the earning per share here to the debt is what? To the common shareholder is higher in the situation of debt. And that is what we mean by financial leverage. If you use finance, if you are using to issue the fund by issuing the debt security, so it will provide you a leverage. And what is a leverage? Some extra return generated to the shareholder because of inclusion of debt in your alternative, or in your debt finance, in your total financing. Okay, this is one point, dear students, you have learned. Now we need to know about another point, and that is EBIT, earning per share break-even analysis here. And this analysis will help you to tell you which alternative is better when. So the EBIT, earning per share break-even analysis, that is analysis of the effect of financing alternative and earning per share, right? So the break-even point is the EBIT level where earning per share is the same. Look, dear student, here the break-even point, that is the EBIT level where the earning per share is same. So look, how much is the level of EBIT here? That is 2700,000, 2700,000 and 2700,000. So in this level of EBIT, the earning per share among all these three alternatives is different, right? I'm just asking you a question. In which level of EBIT, for example, the level can be higher or lower from 2700,000, it can be 3 million, that is can be 4 million or whatever. So in which level of the EBIT the earning per share among three alternative or among two alternative, that is same? For example, if I just make EBIT here 3 million in all of these three, right? For example, 3 million. And then if the earning per share in the common stock and the debt is coming same, for example, then we say that at the level of 3 million EBIT, the common stock and the debt, they are having the same earning per share. So we say the common stock and debt, they are financially at break even. Okay, let assume, for example, look, if I make this, if this is 27 million, I'm not changing it. If I make it 5 here and I make it 5 here, look, intentionally I have made 5 in both of them. Now you can say at the level of $2,700,000 EBIT, the common stock and the debt, they are at break even. Why? Because the earning per share is same at this level. Right now it is not same, look, because at this level earning per share between these two is different, so it means they are not at the break even. So the break even, if you remember in the operating leverage, the break even here is different. In the operating leverage, the break even is a point where the expense is equal to the revenues, but here the break even in the financial leverage is the level of EBIT, right, when the earning per share is same. Once again, if I just make this 3 million, this is 3 million and 3 million, and again it is 3 million here. But in this 3 million, assume here we have the earning per share is 4 in a preferred stock, and the earning per share is 4 in the common stock. So you can say at the level of 3 million, the common stock and the preferred stock, they have the same earning per share. So then you can conclude that the common stock and the preferred dividend, they are at a break even, and financial break even. Why? Because the earning per share, that is same under the same level of EBIT, right? So dear students, if for example this is also 4, so now you can say at the level of 3 million, all of these alternative, right, they are at the break even. So that is what we mean by the definition of break even. Let me so once again, dear students, if you're just paying attention here, none of them are at the break even. Common stock and debt, they are not at break even, and debt in the preferred stock, they are not in. All of them are not at the break even. So once again, just come here. So what is EBIT, earning per share, right? Break even analysis and the effect of financing alternatives and earning per share, where the break even point is What is the break-even point here? The break-even point is the EBIT level where the earning per share is same for 2 or more alternative. So at this EBIT level, no earning per share here among these 3 alternative is same. So dear students, what we are doing right here now, we try to find out the break-even for all these 3 alternative. We can find, where we can find out to understand, right, that the common stock or debt, they are at the break even, or the debt or the preferred stock are at the break even, or 3 of them are at the break even. So now for this purpose, we need to draw a graph, and by the help of the graph you can find them out. And also we have another formula, inshallah we'll work on them to find out the break even for these 2, right? What level we are not knowing here, right? But we can surely say that in the $27,000 level there is no break even among these 2 or 3. Okay, so what is the procedure here in order to find out the EBIT, earning per share, break even? Okay, we need to draw a graph, and for drawing a graph we need to have 2 data set point. Okay, so look, one data set point is given here. For example, we assume whenever we draw a graph, so we have x-axis and we have y-axis. So in the x-axis we have to put the EBIT, and for the y-axis we have to put the earning per share. So we have one data set, and that is given. How much is that? EBIT, how much? That is 2.7 million, comma, and how much is earning per share? That is 5.40. Okay, this is one data set point we have. Okay, and also we have for debt, and debt is how much? If we assume the x-axis is 2.7 million, comma, and 6.30, that is y-axis, earning per share. And here we have 2.7 million, comma, and how much is y-axis? We have 5.35. So dear students, look here, for common stock, if you want to draw the graph for the common stock, right, then this is only one data set point, right, because by plotting only one point you cannot draw a graph. So we need another data set point for common stock, and one for debt, and one for preferred stock. Okay, so let me tell you how to find out these data set points in order to have 2 data set points for each and every alternative to draw the graph. So in this graph, dear students, here we are plotting, this is for the x-axis is for EBIT, and the y-axis is for what? For earning per share. So these are the EBIT levels. So this is 1 million, and this is 2 million EBIT, and here 3 million, 4 million, and these are only the earning per share. So 1, 2, 3, 4, 5. Okay, so now for the common stock we are having only one data set point, and that is 2.7 million. So how much if you try to plot it? For example, this is 2.7, so this is 2, and this is 2.5, and 2.7 is coming almost here, right, in this point. Okay, once again I think I'm having a problem with the pen in this point, almost. Okay, so okay, the second we have is 5.40. so this is 5, and 5.4, this is the 5.4 in this point. Okay, this point, so you can say in this point is coming what? This is the intersection point between these 2 lines. Okay, so okay, only one point is not enough for us. We found this is the common stock 2.7 million, and 5.4 earning per share is coming this point. But if we are not having any second point, so we cannot draw this graph, right? So that is why we try to find out another data set point for drawing a graph. So look here how we can find it. So very much easy, dear students. If you want to draw the graph, we have a formula for earning per share. this earning per share from the common stock, from the EBIT we minus interest, and this then we minus taxes, and then we minus preferred dividend. The same formula is here. Look, from the EBIT we minus I, and then we minus tax in the preferred dividend and divide by number of common share. So it means this process is exactly done in this formula. So this is the formula. If you try not to if you're just trying to directly find out how much is earning per share, so you can put all the data here which is given. This data you can put it here in this formula, and then you can find out 5.40 in all these values. Okay, now one data set point we have here, and we need to find out another data set point, and for this data set point we assumed earning per share 0. What I'm just telling you, dear students, we assume that if we make the earning per share 0, then how much will be our EBIT? If we make our earning per share 0, then how much will be our EBIT? Okay, so that is why if you rearrange this formula for EBIT, then we will have formula like this. If you find out the EBIT from this given formula, right, then if you just mathematically rearrange this formula for EBIT, then we finally have EBIT. So in this EBIT formula, if we assume we make the earning per share 0, right, then how much will be our EBIT? Once again, if we assume or pretend that our earning per share is 0, then how much will be our EBIT? Okay, so we can find it here. Find second data set point, right, data point for all these values, for all these alternatives. So first we try to find out for EBIT. Okay, if you find for EBIT, we are using this formula which is given here. Okay, in this formula, the first we have equal sign, and after equal sign just start the bracket, and then we have earning per share. And how much is earning per share? Look, earning per share in the first alternative common stock, we assume it is 0, right, we assume it 0. Why? In order to find out the EBIT, how much is the EBIT. Okay, plus then we have preferred dividend. If you raise the fund by the help of the common share, there is no need to pay the dividend, so that is why the preferred dividend will be 0. Then divide by number of stock. So how many shares we have in the common share? That is $300,000. So 300,000 not 300,000 shares, sorry. Okay, this is the first portion, and then divide. Okay, divided by what? By 1 minus t. Okay, so when you divide, so you have to give two starting brackets here. Okay, so 1 minus t. How much is taxes here? 0.4. Okay, then close the bracket and divide by number of stock. How much is number of stock? How many number of shares we have here in this? And again, that is 300,000. Okay, and close the bracket and plus 1. Okay, why? Because not 1, sorry, this is I. How much is I? Interest. Why? Because in the common stock we are not having any interest, so put 0 here and press enter. So another data set point we found, that is 0. Once again, dear student, how we found this? Very much easy. Look, just look into this formula and start from EPS. We are pretending here that our earning per share is 0, and then preferred dividend is 0. Divide by number of stock, it's 300,000. Then divide the whole by 1 minus t, and 1 minus t is how much? 0.4, and divide by number of stock, which is 300,000 plus 1. Okay, what does this mean, dear students? This means, if, let me write here, if the earning per share, right, is 0, right, then the EBIT will also be 0. This is the second data set point we found. Okay, dear students, what I'm just telling, 0 means if the earning per share is 0, right, then the EBIT will also be 0. In simple words, this is a formula. Let me make it here. If I just make this earning per share 0, right, so how much supposed to be our EBIT here? 0. Quite clear, right? If your EBIT is 0, so the earning per share will be 0 in common stock. In what? In common stock. So we found another point for the common stock. Okay, now we try to draw this line. Now we can draw the second line. So before to draw this line, let me find out the data set point for debt and the preferred stock, and finally we will draw the lines. Okay, now coming to the debt. Again, if we try to find out here the another data set point for debt, right, we are using this formula. We pretend that what if the EPS or earning per share is 0 here, like for example, if we make the earning per share here 0, then how much will be our EBIT? So you can use this formula. And this formula, I'm just copying this formula and click here directly. Why? Because I need not to just write again the formula here. And in this formula, just bring changes for the debt. So okay, earning per share we make it 0, and the second is the preferred dividend. Again, the preferred dividend is 0 in the debt situation, and then the number of shares in the debt situation is not 300,000. Keep in mind how much? 200,000. Why? Because in the debt the number of share is not increasing. And again here we have 200,000. Okay, because in the debt the number of shares is not increasing. And here next we have to put the interest. This is the final one, is for interest. The interest we have to pay for debt, that is how much? 600,000. So how much is EBIT? $600,000. It's mean if we pretend that the earning per share here is 0, then the EBIT will be how much? That will be $600,000. Or in other words, at the EBIT equal to $600,000, right, the earning per share will be 0. Right, so you can just test this, make it sure. Look, 600,000, I'm just making 600,000, and look here, it is 0. It is what? 0. So dear students, we found another data set point for debt. So you can just put it here. So if the EBIT is equal to how much? $600,000, then the earning per share will be how much here? Another data set point we have, that is 0. Okay, now we come into the third preferred stock. We are just copying the same formula here and just put it here, and we find out, okay, this is the same. Why? Because the number of share in the preferred dividend is also same. Only what is because in the preferred dividend we are not paying interest, so you have to put 0 here. But in the preferred dividend here, in the second point here, this is the preferred dividend. In the formula, look at PD, preferred dividend. Here you have to put 550,000. Why? Because how much is the preferred dividend? Look, that is here, $550,000. Now put here. Yes, we found another point. It's mean in this situation of preferred dividend, if the EBIT is this much, $916,000, right, or 9 lakh, then the earning per share will be 0. Or you can say at 0 earning per share, the EBIT in the preferred stock is how much? This much. So now this is another point. We have EBIT, if we make it 9,1, okay, and comma, how much is the earning per share? 0. So dear students, now we got 2 data set point for common stock, and 2 for debt, and 2 for preferred dividend. Now you can just plot the points and just draw the lines here. So first we are just drawing for what? For the common stock. So one point we found here, and that is exactly here. Okay, so it's mean where is another point to find out. Okay, this is the 2.7. we found it. 2.7 is here, and then we have 5.4. this is 5.4, 1 point, and now coming to this point, 0.0 and 0. So the 0 and 0 is exactly here we have in this point. Look here. Okay, so it's mean 0 here is in X we have EBIT, and 0 we have earning per share. Now you have to connect these 2 points, this line. Okay, you have to connect it. When you connect these 2 points, then you will have like this. Okay, this is correct one. I just plotted a little bit wrong here. So look dear students, at this point, let me make it again here. this point. Okay, this is what for common stock. Now we are drawing a line for debt. For the debt we have 2.7 million again. This is 2 and 2.7 million we have. In the second we have 6.3. So 6.3, this is 6, and 6.3 is this is coming exactly like here in this point. And this point is coming, right? Okay, one point we find it here. Now the second point we have is 6 million, right? So $600,000. This is X. So where is $600,000? So this is 1 million. From 0 into 1 million. This is 5 million. Here is 6, almost about $600,000. Now, so these 2 points should be connected. This point, right? This point, and this point should be connected. When you connect it, so look, we have it like here. Look, we are connecting this point, right, and this point. The first point is this one. You have to plot it. Okay, sorry for interruption. Okay, this point is here. Okay, and the next point is 6 leg. Here is 5, and this point is 5, and here is 6, and then we have 0, 6. This is 6, and here is 0. Look, in the x-axis we have 6, in the y-axis we have 0. So that is why that is coming exactly on the line. So this is the second point. So the second point is here. Look here. So we're just connecting these 2 points, right? So this dash line, this is for what? For debt. We have drawn for debt. So one line we have drawn for common stock, and another line we have drawn for debt. Okay. Okay, next we have to draw for the preferred stock. So dear student, look here. The first point here we have the debt asset point is 2.7 million. Again the same here, and 5.35. So here is 5, and here is this line 5.4, and below this line is almost coming I think here in this point, round about here. Okay, so we have 2.57. Here is 2.7. And then we have 5.3, and 5.3 is coming where? In this line, exactly what where I have mentioned here. Okay, so now we have to find out one another. This is one data set point, and next we have 9 lakh. Here is $916,000. So this is 1 million. 1 million is equal to 10 lakh. So 9 million is coming almost, the line is here, like here, closed here in this point. So now we are connecting this point and this point. It means first we have to show this point, and that is where? That is here in this place, and then we have to connect with this point, and that is here just right before the 9. This is 1 is 10 million, so here is 9 million. But when you connect this graph, finally we have like this. Look, like this one. Okay, so dear students, we draw the graph. Let me make it a little bit more clear. We found here, this one is for the common stock, and this is the first point. The first point is here. This is for 0.00, and the second point, which is 2.7 and 5.4, that is where? That is here. If you remember, we have drawn here. Okay. What we are just learning from this graph. Okay, in this graph we have 2 intersections. One is here, and another intersection is here. 2 intersections. Okay, so what we mean by these 2 intersections, let me explain it further for you. Okay, look, one we have here intersection, another we have here. This mean this line, this is for the common stock, what you see here, right, in blue line. This is for what? For the common stock. Okay, it's mean the common stock is dominant. It's mean up to which point? Up to this point, and this is almost 1.8. This point is the intersection, when you just check where the intersection is lying in this axis, assume this is 1.8, this is 1.8. So dear students, up to 1.8 level of EBIT, the common stock is dominant. This is what? Dominant. What does this mean? It's mean if your expected EBIT, which is here, this, if your expected EBIT is less than 1.8, then the common stock earning per share will be higher. Why? Because here is dominant. Once again, if your this EBIT is expected less than 1.8, right, then you have to select the common stock as your alternative. Why? Because the common stock is providing the higher earning per share, right, the higher earning per share, right, if it is less than 1.8. okay, 1.8 means 18 lakh. Let me make it sure practically. Just I'm just showing you here. For example, I'm just making it 1500,000. How much? 1500,000. Look, I'm at the 1500,000. How much is the EBIT here? 3. And at the 1500,000, look, make it check. How much is EBIT? Okay, it is less. And the common stock, the EBIT is higher. But in the debt, the EBIT is what? Lower. And also the EBIT is lower here. If you make it 1500,000 here, look, again it is lower. So it's mean if your expected EBIT is less than 1.8, right, then in that situation the graph of the common stock is higher. This alternative is better, right? But if your expected EBIT is higher than 1.8, after 1.8 the dash line is dominated. Look here, it means after 1.8 always the debt is better. So for example, after 1.8 I just make it $200,000. Look, 200 yes, 20,000, 20 lakh. Okay, so look, okay, look, and the 20 lakh or 2 million, it is how much? That is 4. And here in the 2 million, it is how much? 4.2. So once again, if your expected EBIT is more than 1.8, it's mean more than 18 lakh, then keep in mind after this intersection point, this debt line is dominated, as you have mentioned here. So I'm just increasing 2 million or 20 lakh, that is higher than 1.8 or 18 lakh. So that is why when your expected EBIT is high in any situation, even here, look here, that is how much? 3.25. So you can only guess that if the expected EBIT level is higher than 1.8 in all situations, look here, it is dominated here. It is what? Dominated. Okay, next dear student, let me make it again 2700,000. Okay, and 2700,000 here, and also 2700,000. Okay, so this was about the line what you have learned about the common stock and also about the debt. Next we have the preferred dividend. If you compare the preferred dividend line, this line, with the common stock, so they have the intersection where here, it's mean 2.3, it's mean from the 2.7, this is 2.7. If the expected EBIT is higher than the 2.7, then the common stock is doing better than the preferred dividend is doing better than the common stock. Okay, it's mean after this point, look, if you are comparing only the preferred stock and the common stock, so the preferred stock is dominated here in this point, where means after 2.7. It's mean if your expected EBIT level is higher than the 2.7, higher, this is 2. No, sorry, not 2.7, 2.7 is coming a little bit here, right? So if it's mean your expected EBIT is more than this point, 2.7 or 2.8, some have here, I'm not sure which point is exactly this one. In the next formula, inshallah, I will show you how to precisely just lie all these and know about these points. Okay, so you can say in this point onward, the preferred dividend is what? Better. Okay, it's mean in the 2.9, in the 2. In the 3 million, in the 3.1, and after this point the preferred dividend is dominated. Let me check it. For example, I just make it 3 million, right, or 2.9 million. Okay, so let me make it 2900,000 between the common stock. This is the comparison between the common stock and the preferred stock. 2900 million here, and sorry, 29 lakh. Okay, and make 29 lakh or 2.9 million. Okay, yes. Okay, so look, dear students, in this situation the preferred dividend is having 5.95 per share and the common stock is having 5.8. Why? Because if you're only comparing the preferred dividend and the common dividend, so it is telling us in the graph that above 2.7, if it is 2.8, 2.9 or whatever, if it is 3 million or 4 million in this area, after this point the preferred dividend is dominating, right? For example, so what you are learning here, dear students, you are learning that if you are given 3 choices here and your expected EBIT level is higher than 1.8, then the debt is always better, right? Because onward to 1.8 the debt is always doing well, right? But if you are given 2 choices, one is the preferred dividend, the common stock, and there is no debt, then you have to learn that above 2.7 you have to select the preferred dividend as your alternative. Why? Because above 2.7 million the preferred dividend is doing better. Why? Because the line is dominating here. This is the intersection. But if you are given the 2 choices, one is the preferred dividend, the common stock, and your expected EBIT level is lower than the 2.8, investment in this area, then the common stock is dominating. From this point onward up to this intersection, the common stock is dominating, right? But keep in mind, if you are given the choice between the debt and the preferred dividend, again you have to select the debt. Why? Because the debt onward 1.8 it is dominated. But if you are given the 3 choices and your expected EBIT level is less than 1.8, then you have to select the common stock. So dear students, the debt and the preferred dividend in this graph, in these two, the debt graph, this one dash line, and the preferred dividend, these 2 lines, they are not having any intersection points. It means the debt always is higher than the preferred dividend. It means in any situation the debt is higher than the preferred dividend in this given example. So dear students, you have to learn from this graph, and you should know that where you have to select which alternative. And dear students, this is the intersection point. You have finally what we learned about. This is the intersection point. So in this intersection points mean in this level, in this point, whatever is this, in this level of EBIT, which is 1.8, which is what? 1.8. So at this level of 1.8 EBIT, you can say the earning per share between the debt and between the common stock is same. It is what? Same. So this is, you can say this is called the break even, the financial break even between the debt and the common stock. Why? Because in this intersection point, which is 1.8 level, it means at the 1.8 EBIT level, the earning per share between 2 alternative is same. And here you can say at 2.7, here is 2.7 or whatever. For example, not 2.0, sorry, it is maybe higher, that is 2.75 or whatever, like this. You can say between this EBIT level, the earning per share between the preferred dividend and the common stock here is what? Same. So this is the EBIT level between the preferred and the common stock, and this is the EBIT level between the debt where the earning per share is same. So and at the intersection of these 2, the EPS is same right here, and also the intersection of these 2 graph or these 2 lines, the EPS is what? Same. So this level, you can say this is the level at which these alternative or at break even. But keep in mind, dear students, the debt and the preferred dividend, they are never at a break even, because there is no any intersection point between the debt and the preferred stock. So dear students, I hope you have learned, and this was all about financial leverage. And inshallah, if you have any question in the coming class, you can ask me, or you can just put a comment and I will explain to you, inshallah. and we will proceed with some more example in the coming class to know and understand the financial leverage in depth. Okay, dear student, have a nice time and wish you good luck. Assalamu alaikum warahmatullahi wabarakatuh.